Monday, everybody. Is everybody doing okay today? Yeah, so this is kind of a lower energy Monday because obviously the Super Bowl did not go the way of the Chiefs yesterday. I actually got into a disagreement with one of my graduate students earlier this morning. So I've made a comment and it said, I think you jinxed us, Dr. Barnes, the Chiefs win. And I said, well, I made the same comment the past 2 years to my students, and the Chiefs won the Super Bowl 2 years previous to this. So I'm like, if I'm going to take the blame for this year, then I think I should take the credit for the previous 2 years. And I'm okay with that, like in a 66.2 thirds conversion rate, or 62 thirds conversion rate for the Super Bowl victories. But unfortunately, it was out of my hands, and yeah, that was unfortunate. But I think that it doesn't really matter with the Super Bowl. There's going to be a lack of energy because obviously everybody's kind of deflated because the Chiefs didn't win, and I get that. That's unfortunate. The Chiefs had won. Everybody had been really, really big and celebrating and using a lot of energy yesterday, and they'd been tired from all the celebration and victory yesterday. So I don't know which it is, but regardless, we have to move forward regardless of that. And it's unfortunate that we have to do it today because today is a pretty intense and rigorous day. We're going to be talking about the revenue process, which next three lectures we have, next three chapters we cover are going to be business process areas. These should be familiar already, should have some engagement with these concepts already. This is the way we frame businesses, and it's really important to understand it. They don't necessarily exist in a vacuum. They are going to relate to one another, but it's really important to understand that this is where everything that we've talked about so far in this course kind of comes together. It's all comes full circle. So we're going to start talking about the nature of the business process. Then we're going to talk about how we actually depict that through graphical representations, which remember BPMN diagrams and UML diagrams. This is where we're going to apply all that knowledge. So this is one of the more important areas we're going to start talking about. It's also important to note that once we get through the next three chapters, which are going to be revenue, next week's purchasing, and then inventory after that, we've got an exam shortly after that. So we're kind of wrapping up everything we need to this point of the course. So yeah, as I go through this, you're going to hear me stop and say, please make sure you spend a lot of time focusing on this item. When I stop and say something like that, it's not just me pandering. It's basically me telling you, this is something that's 100% going to go on an exam, probably in something similar to this format. So you should spend a lot of time focused on that. Especially when we get to the UML diagrams, I will say that the failure rate goes way up on the UML diagrams, even though every single time I talk about it, I say, this is definitely going to be on the exam. This is definitely what you should focus on. So when you hear me say that, make a note of it, saying, spend sufficient time on it because it's going to be very, very represented or heavily represented on the exam. That being said, everything is important, obviously. We've got to talk about everything that we need to know. So let's go ahead and get started. I was preparing, I was going to say a note for this. I was preparing for this class and I was listening to my YouTube lecture from last semester. And sometimes I impress myself with how intelligent I sound. Sometimes I depress myself with how silly I can sound. But I was doing it in between the previous period of class from like last class and this period, and I was a little bit out of time. So I listened to myself on 2 times lecture speed. Me talking at 2 times is ridiculous. Nobody should ever have to go through that. But when I slowed down, it was really weird. I felt like I was just really, really mellow. Everything was just chill. So that's what I'm going to try to do is I'm going to try to be mellow for you guys. If I speed up too much, because I'm getting excited about things that I'm talking about. That's the goal here. Let's talk about the revenue process. You should have some familiarity with it. So the book calls this the sales and collection process. I refer to it as the revenue process. They're the same thing. There's not really any difference here. I don't know why the book refers to that because every other book I've ever looked at referred to this as the revenue process. I realize that there's sales and collection elements due to the nature of accrual-based accounting. So that's going to be important to note. Also, something to make an important distinction about is this revenue process is generated for a business to business environment. Has everybody heard that term before, business to business environment? So let's distinguish that from something called the business to customer environment. If I'm talking about a business-to-business environment, usually that means that we're talking about one business that's doing or performing operations with another business. And that's distinct from a business-to-customer environment. Business-to-customer is easy to understand. That's Taco Bell. When you walk into Taco Bell and say, I'd like to buy a Mexican pizza, and you hand them the payment, and they give you the goods right there. Usually, these are going to be immediate transaction recognition events. Now, the reason I make that important distinction is in a business-to-business environment, usually you've got transactions that are frequently occurring to multiple businesses. So you've got a customer and a vendor, and that customer may buy from the same vendor many, many times within a small period of time. it doesn't necessarily make sense for them to collect every single time there's a transaction. So they grant something called credit. And this is the accrual-based system that we all know and love that creates so many problems for us. Because when credit is granted, the question is, do we recognize revenue now or do we recognize it when we collect the cash? In a cash-based system, we'd say recognize when you collect the cash, but we're under accrual-based system in accounting, which means that we recognize the credit or recognize the revenue now. So that creates some recognition events that we need to be very much aware of and understanding what the transactions look like. So as we're going through this process, you're going to notice me say, here's the recognition event point. And being able to note that recognition event point is really, really critical because we're trying to align this all back to our accounting information system. All right, with that out of the way, revenue process. So nature of any transactions vary depending on the type of organization. You should be familiar with some of these already. Merchandising firms was your focus back in accounting 220. Then you start talking about manufacturing firms with some emphasis on service firms and talk a little bit about the nature of accounting. The good news is the accounting for those particular type of systems is pretty straightforward. You have familiarity with them already, and they don't vary that much. Even though there is some changes, there are some gaps there. For the most part, the type of accounting that you need for every single type is going to be pretty consistent. We talk about governmental entities. Governmental accounting is a little bit weird, as is not-for-profit accounting. Those are all type of organizations that have different mechanisms in place. We're not going to go into that, and we're not going to learn about fund accounting. Not fun accounting. All accounting is fun, but fund accounting. We're not going to talk about that in this course. Suffice to say that there's many different types of organizations and accounting methods we can get into. So our primary focus is going to be on systems in manufacturing and merchandising firms. I will say that the organization that we're going to use as our sample for this particular course is going to be Sunset Graphics. They're a manufacturing firm with service elements. So having that distinction is really important because that creates some nuance to our discussion. All right. So fundamental functions of the revenue process. These should be somewhat familiar to everybody, and you should understand these at a fairly basic level. But there are some things that we need to discuss to be able to set the framework for what we're going to be talking about later. First of all, we're going to have a receipt of the sales order. Now, this is probably not the first this is not the first actual event, but this is going to be what we consider our first transaction point. When I say an event, we can actually have an event that occurs before this. Think about it if you go into it, just like we're going to Taco Bell again, it's pretty standard. You probably don't have your order that occurs the very first thing. The first event is you walking in the door and saying, what is it that I want to order? Unless you're like me, where you already know what you want to order before you walk in the door because you order the same thing every time, okay? But for the most part, you have a consideration. So there could be that point in time, and we're going to recognize that as an event in our diagrams, but we're not going to recognize that as a transaction point in the flows here. We're going to actually say our first transaction point is the receipt of the sales order. In a business-to-business environment, this would include credit authorization because we don't want to extend credit to customers who are not going to pay us back. That's a really bad idea to do business to customers that don't ever give you cash. So credit authorization, a really important point in a credit granting environment. Then we have shipment of goods, assuming that we receive the goods and we say, all right, we're going to do business. We're going to send these out to the customers. This is going to include inventory management in order to understand what flows out. So this is going to reflect back on Chapter 7. We start talking about inventory management in Chapter 7. We're going to reflect back on this. So there's going to be a little bit of cross-referencing there to these concepts. Also, interesting point to note, when do we recognize the revenue? So we're going to be pretty nuanced, or it can get pretty nuanced. We're going to be pretty blunt, but we can get pretty nuanced. Have you heard the term FOB shipping point? Has everybody heard that term? Okay, so FOB shipping point basically says that it's freight on board. When it gets on the truck and leaves the warehouse, it is now the customer's responsibility. We have met our obligation, so we can recognize that revenue once the truck leaves the warehouse. Contrast that to something called FOB destination. That basically says that you can't recognize revenue until the customer has got the truck in there, or they got the goods in their warehouse. So the entire time it's on the truck, it's still our responsibility. Again, we're not going to get too nuanced in this course. For most of our scenarios that we're going to talk about, we're going to assume freight on board shipping points. So once we ship the goods to the customer, we can recognize the revenue. It's now their responsibility. But I do want to make that distinction because that distinction may come up in this course. It will definitely come up in real life, especially if we're talking about large shipments of goods to long distances. So next is going to be issuance of invoices to bill customers. So again, we give them the goods and services. They have an obligation to pay us. We're going to tell them exactly what they should pay us. This is going to include adjustments for sales returns and allowances. Sales returns we're familiar with. I'm sure everybody in this room's done a sales return. They've bought something from Walmart. They said, does not fit me. I'm going to return this. Whatever it may be, you return the good and they return your money. So that's a sales return. What's the difference between a sales return and a sales allowance? Has anybody ever experienced a sales allowance before? So sales allowance basically says that you get your money back, but you don't have to return the good. Okay, which that's the best of all possible world there. Something free, like. So example like this would be like you order a pizza from Pagliai's and you say, this is not what I ordered. I wanted that pepperoni pizza. You gave me a Hawaiian pizza. And then they'll say, oh, sorry about that. Go ahead and keep pizza. We'll deliver you new goods. So you actually got, you're going to get what you ordered, but you also got a free Hawaiian pizza, which depending on your perspective on Hawaiian pizza is either a free pizza or something going immediately into the trash. Okay. Again, depending on what your perspective is. College students, I would assume that most of the time you say, I'll just take the pineapple off. But one of the two is going to be the case. An allowance is basically saying that the good cannot be returned for credit, so we're just going to extend the credit and keep the good. This comes up a lot during restaurant transactions. Also, it's interestingly enough, Amazon transactions for perishable goods. Has anybody ever ordered something perishable off Amazon? You know the snack cart upstairs? I used to order exclusively off Amazon for the snack cart, and I had one company that shipped the wrong goods multiple times to me. And every single time that they ship it, they ship me the wrong goods. So this is not what I ordered. They say, oh, okay, we'll tell you what, if you want to, you can just keep that good and you can pay a discount on whatever you paid. And I said, no, I don't want to keep this good. And then they'd have to say, all right, well, you can just go ahead and keep it because you can't ship perishable goods back to us. They were trying to get me to pay for something that they already shipped me. Okay, so that's a good piece of note just for value. If you ever order perishable goods off Amazon and they send you the wrong stuff, that's free merchandise for you all. And I'm teaching you bad behaviors. I realize that right now, but it's important to know. It's important to know. It's their responsibility to ship it right. All right. The receipt and recording for goods or customer payments. Okay, so this is basically when the customer sends us the payment for the transaction. We're going to record that. This is actually going to be a different type of discount. So we've got cash discount. I'm going to write on the board, but always comes up. So has anybody seen this nomenclature before? Pardon my handwriting. That's 2/10N/30. Okay. So that basically says that if you pay within 10 days, you get a 2% discount on your bill. But if you pay within 30 days, you have to pay the net amount. So that's trying to facilitate faster payments, making sure that you get customers send transactions. So you give them a minor discount within paying certain times. That's a cash discount. That would be included on the recording of the customer payments, not on the sales discount of the transaction itself. So a little bit of a distinction there, but important to note. All right. So let's go ahead and let's categorize these according to the journal entries that we learned back in 220 and 221. So when you actually make the sale, you recognize you have debit accounts receivable, and you're going to recognize a credit sales. There's technically sales tax payable on there too. I will tell you right now, if I require you to record a journal entry, you don't need to worry about taxes. We're just going to ignore the effect of taxes for simplicity purposes. I realize that Dr. Caden probably would be, turning over in her grave if she was passed away, but whatever. The simple truth is we're not going to worry too much about taxes because it's just it's not a meaningful effect on what we're doing. But then we actually could actually recognize also payment on the transaction itself. We actually recognize the cash on the sales. That's also a form of the transaction that could occur. These are definitely two different types of transactions. Again, this is more a business-to-business environment transaction where we extend credit. This would be more of a business-to-customer environment where you pay immediately. Obviously, whenever you sell inventory, you have to recognize the cost of goods sold. So there's the alternate side of the transaction. Everybody remembers that from 220. We're recording those sales transactions. There were two sides. There was the sales transaction and the cost of goods sold transaction, which get reported. And then we're going to recognize the collection of cash, which is that debit to cash and the credit to accounts receivable. And in most of our scenarios, I think all of our scenarios, we're going to assume the customer is going to pay us just because it's a simplifying assumption. I wish that was the way it worked in the real world, sadly. All right. So having defined that and reflected upon everything we've talked about, we're going to refer back to these events and to this information. But let's move forward with the things that we need to know that's specific to this course. So we've got our company called Sunset Graphics. And as I said before, this is a manufacturing company with a service element. So they create items, but they also provide services associated with those items. And it's an important distinction because it's going to affect some of our information. Some of the information is going to be unique that we need to present. It's going to be unique to this particular company. I'll explain more here shortly. They design and sell signs and banners, lettering, and mailing graphics for vehicles and boats, corporate promotional items, and silk screen T-shirts and embroidered gear. So pretty cool company, yeah. And I think this is the this is the Shutterstock graphic. I was trying to look for a graphic for someplace like called Sunset, and I said, "Show me a picture of something with sunset in the background," and that gave me that. Not an actual Sunset Graphics logo, but you can imagine that it is. All right, you can imagine that it is. So the book example, this is just a summary of everything. It comes on page 135. Let's go ahead and reiterate these because we'll need to know this for our diagramming. So they prepare a quote for products and services to be provided to the customer. I already alluded to this. This is kind of the event that starts our revenue process. Even though it's not an actual transaction point, it is an event that we would want to recognize. Customer places an order for all or part of the quoted products or services. This is where they send the sales order in. We would actually prepare that or process that sales order, and we'd ship the goods out to the customers. And actually, we would have to order from our vendors first if we don't have anything. Then we would apply graphics. Now, make a note here on the apply graphics. This is a unique step. This is a service step. This would not be something that would occur in a traditional manufacturing environment because this is taking something they've created and they're applying it to another item. So the reason this comes up is that we will see this in one of our diagrams, but this would not be included in every diagram. We'll see why here shortly. Then they deliver the products to the customer, and then once the customers receive the goods and services, they have the right to bill them because they've met their performance obligation. They bill their customer and collect the payment. So can we agree that this is a pretty straightforward process area? We can identify this. All right, let's take this and let's transition this to our BPMN diagram. We're going to take these steps and we're going to fill them out according to our business process management diagram. All right, so here's a basic BPMN diagram, and I have got great news for everybody in this room, okay? This is the highest level that you will need to be able to replicate on the exam, okay? So if I ask you a question and say, create a BPMN diagram, this is the type that I want you to create. That does not mean that you're not responsible for the next two diagrams that we're going to talk about, but I will not ask you to replicate them. I will just ask solely interpretation of the diagrams. So everybody understand the difference? When I say replicate, means you have to create the diagram by hand yourself. If I say interpret, I will give you the diagram and you'll just have to tell me what certain points or information refers to. All right, so we're going to keep this pretty straightforward. So again, customer requests a quote. This is our beginning event right here. They provide the quote from Sunset Grids, and the customer says, all right, I'm happy with that quote. I'm going to send in the sales order. So we receive the sales order, prepare the products, and then you will notice that once the products are prepared, they apply those to the goods. So like we're talking about a back window decal on a vehicle, all right? We'd have to have the vehicle there in order to be able to provide that service. Again, this is a unique step in most of our BPM diagrams, and the reason I point this out is if you were to replicate this diagram for whatever reason, whether it may be to homework or for the exam, in all likelihood, this would only be applicable if there was a service element included. So this is an additional step that's unique for this particular company, this apply graphics. This would not happen like, say I give you another company on the exam, which I almost certainly will, you would need to note, okay, is there a service step here? If not, you would leave this step out, okay? This is a reason important information because it's relevant only to this particular company. But regardless, once the products are prepared, we're going to deliver those goods and services to the customer, okay? Once the goods or services delivered to the customer, we send them an invoice, and then we receive payment, and that closes out the transaction loop. So pretty straightforward BPMN diagram, but there's a few things to talk a little bit about. First of all, where do we recognize the transaction? So remember our transactions, if we go back here, we have two types of transactions. We've got the transaction that recognizes the revenues, okay? So that'd be this transaction here, or this good journal entry here, as well as this one down here. So accounts receivable and sales, cost of goods sold, and inventory. Where do we record that? Give you a hint. It says right where it says record sale is where it is. Deliver order right here, okay? Deliver order. So for those of you who've taken 302, do you remember the concept of performance obligation from 302? Dr. Eisen talking about that in revenue process? That's basically when we've met our end of the deal as the business. We've given the customer what they've ordered. We have the right to recognize revenue at that point in time. Now, as we know, accrual-based environment, this is not the same as when we collect the cash for the transaction. That's the reason that we have accrual-based accounting, okay? And it's a little bit wonky, but that's the reason for it. So this is going to be, once we deliver the order, this is going to be a record for the sale. Now, again, if we want to get really, really nitpicky about it, we could say, what if we say, Dr. Barnes, what if we say it's a freight on board destination versus freight on board shipping point? We're not going to make that distinction too clearly. I'm going to say for most of our examples in this course, I'm not going to say most, for all of our examples in this course, we're just going to specify freight on board shipping point. So the moment it leaves the warehouse or it goes towards the customer, that's when we recognize the revenue. Okay, we recognize those transactions. And those transactions, again, would be our revenue transaction and our cost of goods sold transaction. Both of those get recorded at that point in time. All right, something a little bit more subtle that's not actually blaringly distinct or talked about on the diagram. There's two elements. There's the revenue transaction and there's the cash collection, okay, the cash receipt. Where should we record the cash receipt journal entry? Anybody think it might be at this point where you say receive payment? I'm going to go with that one. It seems like the most logical step. So again, we go back, we got our cash and accounts receivable. So that's when we collect our accounts receivable and receive cash from our customer. That's going to be receive payment. Now, I know that seems really, really simple, but it's a 100% chance that I will ask you to be able to identify those on a BPMN diagram, because we do need to understand that within our graphic, we need to understand how that relates back to the accounting information itself. This is, after all, an accounting information systems course. So we need to know within this graphic that we created, how does this relate to the accounting transactions that we've documented? So this is pretty straightforward. Now, the next two are a little bit more complex. Again, I want to clarify, this is the only one that you need to know how to replicate. And you will have to actually make that conditional. Like, when if I ask you to replicate this on the exam and I see apply graphics on the exam when there's no apply graphics step, I will say, yeah, that's not correct, okay? And I will count off of that. You do need to be able to understand how to actually assign these activities in different scenarios. But for the most part, it's going to be very similar to this diagram right here. What about with customer interaction? So we've actually got multiple pools now, because remember, in a BPM diagram, we can have multiple entities which are represented in pools, and we've got interactions between those pools. So this one is just the same diagram as we saw before, but actually shows what the customer interactions are at each point. So we provide a quote because they provide a quote, the customer is going to receive that quote. The customer is going to decide, then based on the quote, they're going to place order for all or some of the goods. And so we receive the order. At that point, we're pretty much autonomous until we deliver the order. The customer is going to receive that delivery. They're also going to receive an invoice from us, and they're going to have to make a payment based on that invoice. All of this is fairly intuitive. All this diagram is showing is what is happening on the customer end versus what is happening on Sunset Graphics end. That's all there really is to it. Again, keep in mind here that we presented this form. This is delineating the two entities by pools. If I was trying to show something that was going on within the organization, those would be distinguished by lanes, okay? Different departments are actually shown by lanes within the same pool. Finally, we've got this one right here, which I do not like this diagram, but you know what? We're going to talk about it because it does talk about a few things that we might have to consider. One of the big reasons I don't like this diagram is because we have a decision gateway. And what did I tell you guys about decision gateways? We always have to have. There's always have to be two of them. There has to be the opening and the closing a decision gateway. We don't see two decision gateways here, which really annoys me because it triggers my OCD. All right. But ignoring that, we're going to get past it. Okay. We're going to get past it. So we're going to check and see if the product's available. We've got a yes, no question. If it's available, we can go ahead and do our work that we've talked about before. If it's not available, then we have to purchase. That's going to be the decision point. And presumably, once we finish that, then we would close the gateway and apply the graphics. But they don't actually close the gateway because I guess that they didn't want the diagram to get too complex. It does seem to be another interesting decision point here. What if we reach out to the vendor and they say, I'm sorry, we don't have the goods available to be able to provide that? If we don't have the goods and the vendor doesn't have the goods, can we provide those goods to the customer? No, it's very obvious that that's not possible. So we notify the customer, and that would be the end event. We basically say, I'm sorry, we can't fulfill your order. So apologies, but that's it. That's all there is to it. There's also another interesting point, which is not in our original diagram, but let's talk about this just hypothetically in the real world. In the real world, is it possible? I know that this is shocking, but is it possible that a customer may not want to pay us the good or the money that they owe us for the goods and services we provided? I know that it's hard to believe that may happen, but it can actually happen where the customer does not pay for goods and services. So if that's the case, after 2 weeks, if they've not sent us payment, we might send them a friendly reminder saying, we're still waiting on your money. Please send it to us. Hopefully it's a friendly reminder, because if it's like 3 months after payment, then it's less than friendly reminder. That's where you start having to send stuff to collections. That's where things get really, really nasty. But that's kind of an interesting implication of that. All right. So is everybody on board with this? Feel like they know this? Hopefully the answer is yes. Hopefully you're all nodding your heads, or at least nodding your heads in your heart. I don't know how that would work. But you feel comfortable with this, because now we're going to get to the fun stuff. All right. And by fun stuff, I mean the tricky stuff. This is the UML diagrams. Okay. So we're going to start off simple and then we're going to get more complex. My expectations of the UML diagrams are pretty high. We'll see what that means here in just a second. So before we start, UML diagrams, we've talked about them already. UML diagrams are depicted by 3 series of classes. We can actually have a 4th series, but we're going to talk about the primary 3 classes. There are 3 entities. What are those 3 entities called? Or what are the 3 entities? Give you hints. They have initials of R, E, and A. Resources, events, and agents. Good, very good, okay? So we need to define what's going to happen. In our particular our scenario, we've talked about how we're starting out and the customer is going to say, hey, I would like to buy from you these goods right here, and we're going to provide them with a quote. Sunset Graphics will provide them with a quote for the goods and services they provide. That is our first event. I defined that as an event earlier, so we're going to say our quote is our first event. Who would be involved in that quote? What would be involved in that quote process? Probably the customer. That would be, could we define the customer as an agent? They're a party that's involved. Would employees also be involved in that? Presumably somebody at our organization would say, hey, here's the quote, okay? And then what about resources? What is it that they're possibly going to buy from us? Products, maybe services, some sort of resource. We're going to keep it simple. We're going to say products. We're not going to try to get complex. By the way, you will hear me frequently say that when we get to UML diagrams, I'm going to keep this as simple as I possibly can. Because every single time that you add a class to a UML diagram, it creates more relationships and associations. So as we're going to see, this is our first baseline graphic here. In our next graphic, we're going to add exactly 1 class, and it's going to get a whole lot more complex because we have to document multiple associations. So as we see here, here's our quote, is our event here. Our quotes involve products that are a resource, and then quotes also involve employees and customers. So the interpretation of these multiplicities are pretty straightforward. Let's start here. Number 1, employees can have 0 quotes. You can have employees that do not provide quotes, or employees can provide many quotes. That could be their sole responsibility, so they've issued many quotes over the time they've been there. A quote can be issued by 1 and only 1 employee. All right. Quotes are issued to 1 and only 1 customer, but a customer can receive 0 quotes. They could actually just never have a quote at all. They could just buy, like business to customer example would be an easy one of that. Let me have a Mexican pizza. Or you could have a customer with many quotes. They've tried to purchase many times and they've received many quotes from us. Over here, the products, okay? Quotes have to involve at least 1 product. Doesn't make sense to have a quote if there's no product involved associated with it, but a quote can involve many products as well. We can sell them many items or have many items in the quote. Products can be involved in 0 quotes. We can never sold a product that we have our item or never receive a quote for them or never send a quote for them. But that product can also be associated with multiple quotes. Again, I know this is pretty remedial, but it's important to make those distinctions. We're not going to go through every multiplicity, but we'll talk about some of the more important ones as we talk here. Interpretation of these multiplicities is very, very important. You will absolutely 100% be asked to perform that on your exam, so please make sure you're familiar with that. And if I say anything that's confusing and you're saying, Dr. Barnes, I don't fully understand, raise your hand so we can re-clarify that. Because again, the reason I'm running through this is to make sure that everything's fairly straightforward. All right. Let's add in a new element. We're going to add a class of orders because once the quote has been approved by the customer, they're going to order from us. I have added exactly 1 class to this diagram, and look how different it already is. The reason I say that, I added from this diagram, I had 1 event. I've added a 2nd event. That's all there is to this one. How did this get so much more complex? Because when you add a new class, you have to consider all possible relationships that exist among current classes. So in this one, orders involve products, orders involve quotes, orders involve employees, orders involve the customers. So not only did I add 1 event, I also added 4 new associations. Now, I'm not going to talk about each of the associations because most of them are fairly intuitive. Let's talk about the one between orders and quotes, okay? So each quote can result in a minimum of 0 orders. So we have a quote and they can say, you know what? I don't feel like ordering. I'm going to order from somewhere else. So no quote or no order associated with a quote, but a quote can be involved in many orders, maximum orders. So you could have a quote and say, this quote is good for the next year. Anytime you want to buy over the next year, you could use that quote. And you can use that quote multiple times. So that's a possibility. An individual order can have 0 quotes. So you could actually make an order without ever receiving a quote because you know what the amount is. Or an individual order can have a maximum of 1 quote, okay? Only 1 quote associated with the order because once you've made that definition about what the amounts are, that's it. That's all there is to it. So important to make a distinction there. All right. So that's orders. So we made the order. Let's talk about the last step, okay? So assuming that we fulfill the order on our end, we do have to actually have one last step because, again, we've not involved all of our resources here. Not involved all of our resources here. So what's another resource that would be involved in this revenue process? Obviously, we send goods to the customer, but is it fair to say that if we send goods to our customer, we want to receive something in return? What is that we want to receive in return? A positive review on Yelp. Yeah, thumbs up. Yeah, did good job. Fantastic. Thank you very much for all your. Now, obviously, that would be wonderful, but what's the resource that we want? We want cash. We want cash. Okay, so we have to get cash. So there's got to be cash. If that's the case, is there going to be an event associated with getting cash? Like a cash receipt? Yes. Okay. So we're going to add two more classes on here. Here's our cash receipt, and here's our cash. The good news is cash is really only associated with cash receipts. So we only have to have that one resource associated with that event. But the event itself has multiple associations. The event has an association with cash, with orders, with employees, and with customers. Okay. So let's talk about the new associations. Again, there's multiple associations that are created, but some of those are fairly straightforward. Let's go ahead and talk really quickly about these. So cash receipts and orders. Each order is related to a minimum of 0 and a maximum of 1 cash receipt. So what is that going to tell us? It says that we could actually fulfill an order for a customer and they could never pay us. Possible that's the case. They could never pay us. That's zero cash receipts for an order, which stinks. We don't want that to happen. That's certainly a possibility we must acknowledge. Presumably, if they pay for an order, they pay it all at once, okay? Now, this is kind of a simplifying assumption. You could actually say 0 to many here, because it's possible that a customer could pay for an order in installments. They could actually have multiple cash receipts. But in this scenario, in this business, I think it's probably safe to say that they pay for it all at once. All right? And then a cash receipt can be applied to one order or to many orders. Now, this is an interesting one. Why is it one to many orders? We know that it could be applied to one order, but is it possible you could have somebody who's a customer that has many transactions and they say, here are all the invoices that I owe for. I'm going to give you one check for that in all those invoices. Certainly. Okay. That's a possibility. That's what we're talking about. And then, of course, cash receipts involve one bank account. Okay. It goes to one and only one bank account. And a cash account can have 0 cash receipts. We can never put money in that bank account. It can just be there and empty, or it can have multiple cash receipts. Okay. This one is probably not a really important multiplicity to understand, but it's still important to note just for integrity purposes. But again, this is kind of our fulfilled diagram of all the entities, all the classes, not all the entities, but all the classes within the revenue process. All right. You probably were waiting for this. Now let's go ahead and talk about this. So you will need to be able to replicate this diagram, okay? And I realize that's not fair. It says, Dr. Barnes, that's not really fair. It's like, why are you asking that much stuff? Like, well, the simple truth is that if I asked you to replicate any one of these levels, I would have to include it, incorporate other levels as well. So this is the full level. Now, you may say that's really, really complex, and I would say I will sympathize. This is fairly complex, okay? The good news is, if you learn this, you should feel really, really good about where you stand in the exam. Now, keep in mind, this is one of 3 diagrams of this nature. We're going to have another diagram that's very similar to this one when we get to the purchasing process. And then we're going to have another one that's not at all similar to either of the other 2 in the inventory process. But you do need to learn all 3 and be able to talk about how all 3 interact. Okay. So replicate 100% for this one. And when I say replicate, you need to know all of the classes, all the resources, events, and agents. You need to know all the associations and need to know all the multiplicities, which is a lot to ask, I tell you, but it could get worse, okay? I could ask you about conceptual structures, or remember that UML nightmare diagram that I did back in chapter 3? I could ask you that, which I don't. I won't ask you that. That's just way too much. So it could be a little bit beyond that. So this is the replicate diagram that you need to know. So make a note of this. Again, I cannot reinforce this or reiterate this enough. This is the one area where my students have traditionally struggled right here on these UML diagrams. They don't take this part seriously enough. Say, I wonder what he means by replicate. For surely he can't mean the whole thing. I mean the whole entire thing. Every single element that's on this diagram here, you should be able to replicate this. The good news is the amount of variance that it will ask you on the exam is minimal. So if you can replicate this exact diagram on the exam, there will not be a lot of room for me to change parameters. Like I won't change any of the classes. I will very rarely change multiplicities. Again, some multiplicities may change. Like for example, if you have a situation where there are multiple cash receipts that could be associated with one order, that would change the multiplicity down here. which would cause for interpretation, but that's very rare that's going to happen. If you just could replicate this entire diagram, you should feel pretty good about where you stand on the exam. All right, everybody understand that? Have I harped on this enough? Have I said these words enough times that everybody got to get this? Because again, my historical precedent on this is that this has been one area where students have struggled and not taken seriously. I'm going to tell you, take this one seriously, okay? I do want to talk about this last element. So you'll notice I said you do not need to be responsible for replicating conceptual structures, okay? I think conceptual structures can be confusing and they're subject to interpretation. That being said, you will need to interpret conceptual structures. So what is a conceptual structure? It's our other type of class that is not one of our entities. It's not a resource, it's an event or agent. It's basically something about which management wants additional information on, okay? It represents a relationship between two classes that did not exist in one of those forms. So my conceptual structure for this course, remember I said we have two agents, we have student and we have instructor. And I said there's a conceptual structure between us, which is grades, okay? That would be an example of conceptual structure. For here, these are some examples of conceptual structures. This is not comprehensive, but some examples of these. Product categories, which show employees who manage different product lines, okay? So an employee can manage 0 product lines. They could have no responsibility in that area whatsoever, or they can manage multiple product lines, okay? Or product categories, yeah. And then products could have product categories. They have 0 products, they can have multiple products, and a product can be part of one product category and only one product category. Another example is going to be order status. So what is the situation of the order? Has it been shipped? Is it pending? Is it on back order? Whatever it is. Again, all that is representing is a piece of information about which the organization wants additional detail about. It exists outside of the parameters of our traditional entities, resource events and agents, but can convey valuable information and thus may be included in the UML diagram. Once again, you will not be responsible for replicating this. The only replication you have to do for our entities. So remember resources, events, and agents, and all the association multiplicities. But if I provided a UML diagram to look like this and say, provide an interpretation of what the product categories do, you would have to be able to tell me kind of what I just explained to you. All right, to wrap up, let's talk about one of my favorite things in the world, which is not business rules, but something that results from business rules. So remember from chapter 3, we talked about business rules, and I said there were 3 categories of business rules. There's obligatory, prohibited, and allowed. And so obligatory was saying this is something that should always happen. Prohibited is something that should never happen. And allowed is something that can happen. The reason that organizations create business rules is because they're trying to address any risks that exist with the organization associated with transactions or their businesses that operate. We talked about risks at a very general level already. Okay, we talked about risk, and I said one of my favorite things to talk about in every course has to do with responses to risks or controls. So we're going to go in a little bit more depth into the next few chapters about the nature of internal controls. So as I talked about in previous courses, I defined controls as very simply as a response to a risk. But what are they characterized as? And the answer is you've probably looked at them before, whether you realized it or not. So when we talk about internal controls, some very stark examples of these are things that you've seen in the real world. So approvals, so transaction takes place and you have to go to some other authority and say, I'd like to conduct this transaction. And they say, this is okay, or I'm sorry, I can't approve that. One of the two. So trying to approve, usually these are based on dollar thresholds. If it's an approval that requires a transaction over a certain dollar amount. So say you have the ability to run transactions that are below $1,000, anything above that, you have to receive approval for. Authorization is going to be something that's associated like with credit limits. So you've got a customer and they say, we would like to do business with the customer. You say, all right, customer can not exceed this credit limit, or this customer cannot receive any credit whatsoever because of their credit history. That would be an example of that. Verifications, trying to determine information is accurate. And then reconciliations. You guys done reconciliations before? Okay. Done reconciliations in TESA. So some of these are pretty simple, like bank reconciliations. Like you look at your bank account and try to make sure that the amount of money you think you have in your bank account is what you actually have. This is really important, by the way, because if you think you have a lot more money in your bank account than you actually have, that's where bad things start to happen. More simply, a simple, straightforward reconciliation item. How many of you guys have credit cards that you use on a fairly regular basis? Okay. Do you look at your credit card statement pretty regularly? Yeah, it's a good idea because sometimes you will look at that credit card statement and you're going to be saying, okay, I spent $15 at this restaurant. I spent $15. I spent $1,000 on a trip to Tahiti. No, wait a minute. I did not go to Tahiti. I'm pretty sure about that. I would have remembered that event. Okay. So then you go back to the credit card company and say, yeah, this transaction did not take place, and you have to figure that out. Obviously, that's an extreme example, but the whole purpose of a reconciliation for credit cards is to make sure that you're not paying for transactions that you did not engage in. In this day and age of cyber attacks and cybersecurity issues, this is something that's really important. It's a very, very simple control that can prevent you from paying for things that you did not actually incur. Transactions did not really incur. Now, I will tell you, if you really want a trip to Tahiti, take responsibility for that and have a fun time too. All right, reviews of operating performance. Has anybody ever had a part-time job? Yeah, they sit you down for a review and they say, hey, you're doing a good job, or we think you need to improve in this area. Is that something they're doing just to make you feel good or feel bad? No, what is their ultimate goal in a business? So they're trying to make sure that you are doing the job that they've requested you to do. And this review of operating performance is a control over that, to try to make sure that you're not providing risks in areas where they expect you to be responsible. If you're doing a great job, they say, we want you to continue doing a good job, and we're going to motivate that performance by giving you a raise, okay? If you are not doing your job properly, they're either going to say you need to step up your performance, or they're going to say, we're going to replace you, which is an unfortunate conversation that I hope nobody ever has. That's not really a nice conversation to have, but there is a reason for that. It's a rational response in that particular context, okay? Then we have security of assets and segregation of duties. And by the way, I did not just put a picture of a car up here and say the word car to show you I know how to spell it, okay? It actually has a very, very specific context. When we talk about segregation of duties is characterized by the separation of 3 areas of responsibility in an organization: custody, authorization, and recording. More specifically, this is the separation of custody of assets, authorization of transactions, and recording of transactions. The reason this is so important is that historically, in areas of misappropriation of assets fraud, and even in financial statement fraud, what has been visible is that these areas of responsibility have been held by more than one party. So a very, very simple example. Let's say that you work in the warehouse of your company, okay? You work in the warehouse where all the inventory is stored. You have easy access to the inventory, but you can't steal the inventory out because there's basically recording and authorization concerns there. But then your boss says, you know what? I feel like playing some golf today. What I'd really like for you to do is I'd like for you to make sure that all the shipments go out in a timely manner, and you can go ahead and record these shipment transactions for me. So boss leaves to go play golf, and you realize, okay, I can authorize the shipment to this company that I just made up, okay? And they're going to ship goods to your house. Do you think that's really happened in the real world ever? Happens all the time. Happens all the time. Not necessarily the boss going to play golf, but shipments to fictitious vendors, okay? Made up vendors because somebody did not properly scrutinize this area. So when you separate out these responsibilities, this is an effort to try to prevent things like that from happening. So segregation of duty is a very, very powerful control, and one you'll hear me harp on a lot, okay? Custody authorization recording. By the way, I do want to make a note, because this may come up, okay? There's been a point of contention among the accounting faculty. Some accounting faculty may refer to this as ARC, A-R-C. They are wrong. It's always CAR, okay? It's always CAR. So if Dr. Otero gets in your face and says, it doesn't matter if it's ARC, it's CAR, it says, no, Dr. Barnes disagrees. It's always CAR, okay? And by the fact that I'm the auditing professor, I get to be right about this. Okay, I get to be right about this. All right. With respect to information system controls, then we have 2 general categories that we're concerned about with respect to technology. We're going to be, first of all, concerned about general or access controls. This limit who can access an information system, the areas the information system is accessible to each user. Now, I do want to simplify this because that's a pretty technical definition, but it's very easy to characterize, and we'll see this characterized in some examples moving forward. This is what the employee or the user can do, all right? This is basically characterized by what the employee or the user can do. The second of these is going to be application controls. This is generally an automated process that provides detail or for data integrity and audit trail. So what do I mean when I'm talking about application controls? When I'm referring to application controls, I'm referring to what the system does. What the system does, okay? So let's think about this considering what you guys are doing right now. So everybody is on computer right now. Some of you may be logged into Brightspace, all right? So how do we characterize general controls versus application controls in this context? Well, general controls are basically going to dictate what you can access in Brightspace. You can access information about yourself, the assignments in this course. You can access general information. You can't access assignments in courses you're not enrolled in. You can't access grades or information for other students in this course because you don't have a level of privilege. I, on the other hand, I can look at everybody's grades and everybody's performance in this course. Those are defined roles for each of the people who are using that particular parameter. So those are the general controls that are defined based on your user level. Think about NetSuite. We have administrator level. We can access everything in the system. That's not true for different levels. If we changed our role within NetSuite, we can only access parts of the system. So those are general or access controls defined for those particular programs. How do these differ from application controls? Well, the application controls will actually define or will actually track the activity. So you'll go onto Brightspace and you'll say, all right, I wonder what Dr. Barnes has put up for the assignment today. It says, okay, something more about UML diagrams. That guy has an obsession with UML diagrams. All right, so you click on that. Brightspace will record that and say there was a transaction activity by this user at this time and date. In fact, I can tell whether or not you've been on Brightspace within the past week because it actually tells me the last time that you accessed Brightspace. So by the way, if you haven't been on Brightspace this entire semester, I know. Which I know that can't be possible because everybody's been turning their assignments in on time. But I'd be able to tell whenever you access Brightspace if you have not. Okay, so it's important to note. So what is the purpose of an application or an application control? To be able to track all that information. It's because if there's any questions about something that happened, we can follow up on that. We can make sure that everything is possible and is running properly. And that if there was any issues that run up, what was the source of that issue? So say, for example, heaven forbid, one of my students was able to access grades for everybody in this class. That would be a red flag. And we say, all right, how did a student get user access or access of instructor? And it may be because another instructor gave them access because we have the ability to manipulate in Brightspace who can access certain information. And so I actually type in a banner ID for one of the students in the class and say, I'm going to make them a teaching assistant, which then means you get access to all the solutions and all the grades and the exam materials and everything. And then I'd have to say, great, I have to rewrite all my exams. So I'm not going to do that. But that would be what Brightspace would access. That Dr. Barnes, in some moment of insanity, typed in a banner ID for a student that should not have had access to Brightspace, and now they have access to the entire system. So that would be an example of an application control that would track that activity. So with respect to data integrity, applications controls should also provide the following field checks to ensure the data is the correct type, such as numbers or dates. We can't type in like characters for numeric fields and vice versa. Validity checks, make sure that we have acceptable values implemented by drop-down lists or calendars. So you can't type in June 31st, 2025, because there's no such thing as June 31st. There's going to be a limited range of parameters, and it's going to identify that. And then limited range checks to ensure the entries are within appropriate limits. Limit checks ensure that entries are less than an upper bound, whereas range checks ensure they're within a certain range. This is certainly going to be appropriate when we talk about authorization controls. Authorization will usually have certain parameters or limits that can be met. If they go above that, then there needs to be an authorization mechanism that's put in place. The last thing I want to talk about, and we don't really have time to go into a lot of detail here, is talking about access and application controls that Sunset Graphics has implemented in the revenue process. We're not going to go through them in class, but I would like for you to look at table 5-1 on page 140 in the book. What you will identify as an interesting series of characteristics. They're not difficult to interpret, but you do need to be able to make the distinction between what is an access control versus an application control. What were the two words that I said were really important? When it's an access control, it's an employee or user. When it's application control, it's something the system does. And that's going to be a characteristic that we see through the next 3 chapters. We're actually going to delve a lot more in depth in this next week. We'll actually take a closer look at this table for the purchasing process. But since we don't have the time to go through it in class today, I'm going to bid you farewell. I'll see you all on Wednesday.